Good morning. You're watching a home broadcast of Business World Live. I'm Danny Laurel. It's 10:30 a.m. this Friday. It's about an hour into the shortened trading day. It's the last trading day of the week. Let's kick off with our banner story. The government's economic team has unveiled the blueprint that aims to help the economy bounce back amid the COVID-19 pandemic. Finance Chief Sonny Dominguez said the government will be needing as much as 160 billion pesos to bankroll the projects under the three-tiered recovery plan touted as Bayanihan 2. That includes liquidity support for businesses through banks as well as a reduction in corporate income taxes. Now, under the program, Land Bank and the Development Bank of the Philippines, or the DBP, will receive a total of 50 billion pesos. That amount will be used to extend loan credits to microfinance institutions, cooperatives, and rural and thrift banks. The remaining part of the proposed budget will be used to hire people to do specific jobs such as contract tracing. Dominguez says up to 500,000 individuals can be hired. Dominguez says the proposal may increase the fiscal deficit by 0.9%. He says this may generate revenues between 800 billion pesos and 1 trillion pesos because of the multiplier effect. Now, the second part of the recovery plan includes a drastic cut of corporate income taxes to 25% from 30% that's starting July. That's according to NEDA Acting Chief Carl Kendrick Chua. And then the third phase will focus on what Chua describes as a reprioritization of the 2021 and 2022 budget to improve the healthcare system and to support the agriculture and infrastructure sectors. Meanwhile, a report by the Asian Development Bank says the COVID-19 pandemic may cost the global economy $8.8 trillion. That figure represents 10% of global GDP. This cost is more than twice the range of $2 trillion to $4.1 trillion it gave in May. In April, rather, ADB says governments should boost health systems as well as income and employment protections. Back home, a study by Nomura Global Market says the Philippines is just spending half of what is needed to support our vulnerable population. It says the government needs to spend at least 3.7% of GDP to those affected by the pandemic. Nomura Global notes that the Philippines' social assistance measure is worth 1.17 trillion pesos. That is just 1.7% of our GDP. Checking in on our markets this morning, but let's kick off with the remittance figures for the month of February. You can see that on my screens here. The good news is that those were still in positive territory for the month of February. Recall that this is ahead of a lot of the bigger issues that we've seen related to this coronavirus pandemic and ahead of all of the lockdowns that we've seen globally. That was up by 2.5% year on year in the month of February, but that was lower than the 3.7%, which was estimated by analysts. So again, Feb remittances disappointing the analysts. They sent home, this from our Philippine overseas workers, sending home 2.36 billion pesos. This, of course, is according to the central bank. Now, just to reiterate, apart from this and what we've just reported in our banner, we actually have our acting NEDA Secretary Carl Kendrick Chua right now speaking on Bloomberg TV. saying that the Philippines is still in a good chance to see a recovery starting the second half of the year. And he also sees a double-digit unemployment rate nevertheless. Now, another thing that we are going to be watching out for here, and I'm going to be pulling it out for you in my terminal here, is the economic data that is coming out from China. A lot were watching this yesterday or waiting for this, and it did come out at 10 a.m. Take a look at that. Industrial production for the month of April in China up by 3.9% compared to what the survey was, which was 1.5%. So surprising on the upside when it comes to industrial production. Still, year to date, it has slowed or contracted by 4.9%, but still this contraction in production is not as bad as analysts had predicted, which was a contraction of more than 5%. One thing, though, that did disappoint were the retail sales in the month of April. That contracted by 7.5% compared to an expectation of a contraction of 6%. But if you take a look at property investments, take a look at that. It did contract, but lower than analysts had expected. So still, a lot of things are going on in China. Jobless rate as well. The actual came in worse than expected, 6% jobless in China compared to a 5.8% estimate. So markets will be digesting that today. Now let's take a look at how our global markets did. Now, a lot of things happened yesterday. In fact, the S&P 500, if you'll take a look at that, was up by more than 1.1% together with the Dow Jones. And this amid a lot of things going on in the U.S., especially since we had those Fed comments from Jerome Powell saying that there will be a sharper contraction. It will be very hard to contain this pandemic. And still, there were also deadliest days in Texas, biggest increase in new cases since the start of the outbreak after the U.S. had reopened their economy. So a lot of threats going on in the U.S., but nevertheless, the S&P 500 did climb. And I just want to take a quick peek at Asia Pacific and how that is reacting to these China figures. Rather in the red, I have to say, you're going to be seeing the Topix and the Nikkei 225 over in Japan down by 0.4% each. The Hang Seng as well with a bit of pain down by 0.5%. The ones to be watching out for are the Chinese stocks. You're going to be seeing Shanghai and Shenzhen being sold off and down by around 0.2%. So actually not a lot of bright spots here when it comes to our region. Now moving over to us here in the Philippines, we are extending those losses, but you can see that it looks like a bit of a sideways trading since that rebound that we saw since the March 19 lows. We are continuing those declines from yesterday. We're down by 0.9%, closing in on 5,600. Even as yesterday, we actually had a bounce back already after several days of pain throughout this entire week. What actually led those gains yesterday was SM Prime leading those gains. So I just want to take a quick peek on who are the leaders and laggards in this Friday. You're going to be seeing Globe Telecom leading the pack together with PLDT. So the two telco players here sitting out that sell-off. But as I mentioned, SM Prime, and not surprisingly, perhaps after it had gained by more than 7%, is actually the worst performer, now correcting and down by 3.3%. More on markets later on in the broadcast with Rob Ramos from East West Bank. Okay, checking in on headlines we're watching this Friday. The Philippines should work on improving its incentives program and remove unnecessary trade barriers. This is according to the U.S. ASEAN Business Council, which noted global companies starting to move their operations from China to Southeast Asia. The group said there is interest in the Philippines, but the country faces stiff competition from neighboring countries. Vietnam, for example, had been opening up to more foreign investments and taking advantage of the global supply chain shift in the region. Foreign chambers in the country also see the Philippines attracting less manufacturing partnerships with major electronics brands compared to Vietnam. However, the business groups noted that the Sitira bill is a good start to lure investment. The measure, which seeks to lower corporate income taxes and rationalize fiscal perks, is still pending at the Senate. Since resuming session, Senate leaders have given their commitment to pass this legislation. Now, apart from marketing better incentives, the US ASEAN Business Council said the Philippines should also do something about its current COVID-19 tally. The group noted that companies are not going to wait forever to start operations. The Philippines has the second highest COVID-19 case count in Southeast Asia, with close to 12,000 infections. The DPWH will be resuming work on government flagship projects in Metro Manila. Public and private construction projects have been allowed to resume in areas under the modified enhanced community quarantine, provided that workers are housed and fed on site, and as long as distancing rules and other safety requirements are observed. These state construction projects include the Bonifacio Global City Ortigas Centerlink Road Project, the Estrella Pantaleon Bridge Project, and the Binondo Intramuros Bridge in Manila. Now, the department said the Estrella Pantaleon Bridge and the BGC Ortigas Centerlink is halfway done, while construction works at the Binondo Intramuros Bridge is about 30% complete. Construction of the Skyway extension in SLEX also resumes today. San Miguel Corporation, which manages the Skyway operations, said the move to public works restrictions will help them make up for lost time due to the community lockdown. The company has yet to determine a new completion date for that project, but they say they will try to deliver as close to the original October 2020 deadline as possible. Now, two companies reported a drop in first quarter earnings. That's on Thursday. That's due to challenges brought by the government's quarantine measures against COVID-19. One of them is DMCI Holdings, which posted a huge profit fall in the first quarter, citing low market prices amid the ECQ. The conglomerate saw a staggering 78% decline in net income to 616 million pesos in the January to March period, and DMCI's core net income, meanwhile, dropped by 64% to over a billion pesos. The firm says it is expecting the coming months to be even more challenging for the business because of more stringent measures to contain COVID-19. Things are also not looking up for Eagle Cement, which reported a 25% drop in net earnings during the first quarter. Its top line went down 16% to 4.5 billion pesos. The cement manufacturer said this decline is due to a slowdown in construction activity during the period, which reduced demand for its products. But now that construction work will be allowed under the ECQ, Eagle Cement said it's looking forward to recording a bounce back in demand. So here we are at the tail end of what has been a really tough and volatile week with downgrades, earnings outlook cuts, and warnings of even more pain to come. But on the bright side, it also happens to be the last day of a very strict ECQ here in the metro. Businesses are set to gradually reopen. Here to give us his thoughts on what's to come and where to put our money, we have with us Rob Ramos, SVP and Trust Officer of East West Bank. Good morning, Rob, and welcome to the broadcast.
Good morning, Danny. Pleasure to be here.
Rob, I mean, we're gonna have to, kick off with this new global data that is coming out. It's been a mixed picture because this week has just been all over the place, right? You've got the Fed saying that there's going to be even more pain ahead. Today, you've got China coming out with better than expected industrial production figures, at least for the month of April. But then on the downside, you've got remittances slowing down in the Philippines, and even more stimulus that needs to happen because ADB is saying there's going to be 8.8 trillion dollars that needs to be spent for this virus. So tell us, what is the general feeling right now? Are you feeling a bit more pessimistic, a bit more optimistic? Tell us.
I think the main thought here is that a lot of us are cautious. We don't expect a sudden bounce back in the markets anytime soon. The main thing that's happening here is that consumption is definitely not what it used to be. People are not spending, people are not consuming the way we should or we have in the past. So that is impacting everything else. So, people don't consume, what happens? Companies don't make as much money as they usually do. So all these firms that you see in the PSEI, in the S&P, in the Dow Jones, they're not going to make as much money. If you see that people are saying, are you going to see a recovery, a V, a W. I think I would be more looking at a U paced recovery, mainly because of behavioral economics. Even after the ECQ or MECQ, people will not rush out and go to the mall. People will not rush out and go buy a new car or anything like that. What they will do is probably hold their funds pat, and they will do things slowly. And that's the U part. That lower part of the U is people waiting, seeing if it's safe to spend. Am I comfortable not spending as much cash? And once people are able to deal with that, they're able to psychologically deal with the impact of the virus, and at the same time they're comfortable, then they will start spending, and thus we see a recovery. But when that happens, it's probably not going to be anytime soon.
Rob, you mentioned that you're expecting a U-shaped recovery, and a lot of this is hinged on whether businesses, and you're in a bank, get enough help, lifelines, loans from banks. And in this period, banks are worried that that the non-performing loans are going to go up, and that has actually impacted a lot of the first quarter earnings. Tell us, are the government's policies, because Nomura, we just reported, said it's not enough. The fiscal spending is not enough to give the lifeline that the businesses need. Is that what you're feeling right now? Will this actually, what's available, be enough to help us cushion the blow and give us this U-shaped recovery?
I think, of course, the government, they're smart people. They probably allotted the capital that they had for the meantime. Whether or not that's enough, that's something that we have to see. I think the policies that they started are actually in the right direction. I mean, the BSP lowered interest rates, cut reserve requirements, and of course, from a fiscal perspective, the government is pumping money into the system, and that's what we need. They're distributing funds to the people who are most vulnerable. Um, I think the question whether this is enough or not enough depends on how long is this pandemic going to affect us. If the system is longer than expected, then more money has to come through. If hopefully we contain it faster than expected, or we get a vaccine or a cure faster than expected, then maybe it's enough. I think it's always going to be dependent on that, the expectation, how long we will be impacted.
And you, of course, come from a bank, so you can't really say much about the space. But just in a very broad sense, you mentioned consumption needs to pick up, and the
Right.
BSP has been easing and giving ways for us to actually have cheaper loans. We did see loan growth going up in the last sprint. Tell us, how long of a lag is this really going to happen? Because Governor Diokno said it takes 3 to 9 months for these easing of rates for people to actually have this money and liquidity in the system, even as our cut. So how long is this going to be taking? And do you feel that in fact the loan growth will be increasing in the future?
Well, actually, we talked about this the last time I was there, and usually it takes about 6 months from a cutting of rates before there's an increase in loan growth. But that's during usual market conditions. So my
Okay.
expectation is, yes, maybe I think most likely the governor is right. 9 to 12 months before loan growth goes back. That's probably what we see with the lower interest rates. I'm sure the firms, especially the firms who are impacted, they will need all the help that they can get. They will capitalize on these lower rates to get back on their feet. So yes, 9 to 12 months is probably a safe
Fair estimate. Okay. So still quite a while to go before the consumption does follow suit when people do have that liquidity. Rob, let's kick off with some stocks here. I wanted to focus on the Gokongwei stocks because they've been very clear about their guidance for the year. Let's kick off with the parent company, which had released their earnings yesterday, down 71% in the first quarter, cutting their capex and now focusing on petrochemicals. Tell us how were you surprised by these earnings? This, of course, is a conglomerate that owns Cebu Pacific, so not surprising there. But they also had URC, which should have, in theory, in this period, given them some cushions. What's going on here? Okay, I think we lost our guest here. Okay, let's just take a quick peek here at JG Summit while we try and get our guests back on the line. It was a bit choppy, I have to admit. So earlier on, I did mention that JG Summit had released their earnings, and I just want to do a quick feeler on how that parent company is doing. It's actually opening in the red together with the rest of our local boards, down 0.1% here. Now, I did mention that apart from the fact that they're cutting their capex, they're cutting it to 58 billion pesos after they had, or amid their earnings plunging by 71% to 1.9 billion in the first quarter. They actually identified the projects and the payments that can be deferred as they try and pivot. They've also said they're going to be accelerating digital transformation, and they expect shifts in consumer behavior. Now, let's take a quick peek at URC, because this is a stock that a lot of analysts are interested in, but it has not had the same luck, so to speak, as the rest of the pure goals, for example, which has been in the green so far. And also, they have announced that they are cutting their capex by up to 3 billion pesos to conserve their cash. They did mention there's a 35% decline in the profit to 2 billion pesos in the first quarter, but they did say this was mainly due to forex losses, so not necessarily because of the fact that they had losses in terms of their operations. It was really about those foreign exchange losses, but still, because of this pandemic, their president and CEO Erwin Lee is saying that capex will be shaved somewhere between 2.5 to 3 billion pesos. Okay, we actually have Sir Rob back on the stream here. Rob, we lost you for a bit there. I was talking to our viewers here about URC and the fact that their losses were actually because of the forex. So not at least in the first quarter. Do you have good prospects in this stock? Why is it that it hasn't surged as much as the Pure Golds or the Century Pacifics, for instance, especially since they're producing staple goods?
I think that's it. These forex losses, people sometimes don't read between the lines. They see the net income numbers and they worry and they say, okay, they didn't make the money, especially during these times. They should be making more. They don't read it. They don't read into the details, so they stop and they turn around and they let go of the stock.
Okay.
But personally, I think, like what you said, they are into consumer non-discretionary. These are the stocks that are probably going to do well during these times. So you're right. There are a lot of good prospects for them and the other stocks in their particular sector.
Okay, this, as you mentioned, maybe investors still haven't accepted that it's just the forex losses or these are temporary things to pivot. But are you seeing difficulties in terms of the supply chain and the bottlenecks, especially as they get products from abroad as well and ingredients?
I think the main problem here is that people understand the supply chain as it is. But what I believe, especially with this large conglomerates, is that I've heard a lot of people talking about refitting their supply chain, changing it up to make sure that they're more efficient. At this time, I think that these guys have already talked about it, and they're just probably a few weeks, if not a month, away of changing their supply chain. So that being said, these people know how to run their business. They've done it for so long. So by probably give them a few more weeks, we'll see a improved and quicker supply chain for them.
What's your insight on RRHI? So they're doing pretty well in terms of consolidating Rustan's sales. In the same store sales growth also was not really necessarily bad. But now the retail arm is going to be taking a hit. Will the supermarket grocery arm actually, offset the losses from the retail sales? And can they actually? They're saying they're going to pivot into e-commerce and transformation. How long will this take? Are you bullish on RHI?
I'm actually whenever I'm bullish on consumer non-discretionary. Basically, that's what I think. And if
Okay.
they're able to pivot in one way or the other into this particular sector, then I am definitely bullish. During this time, anything that has to do with consumer staples will have the chance to really outperform.
Okay, so bullish on RHI, which by the way is also opening in the green, bucking that sell off. Rather flat though, 0.07%. At least it's not in the red rub. relatedly, because you're saying consumer staples, what about the Merrimart IPO? So they have actually now said in their prospectus on the IPO, they will that any decrease in demand for what you were mentioning, discretionary products, will be offset by the increased demand for non-discretionary products and consumer staples. So they are still asking money. Will you be buying into this IPO? I mean, or recommending that, especially in this period of volatility?
I think it's two pronged. I always tell my investors, you know what? Do you have money that you don't need for the short term? I think that's the first question that I ask them. Are you willing to invest on a long term perspective? The second question is, what sectors do you think will do well given the current market scenario? For that second question, yes, they don't have they're new in terms of an issuance, but it's a bright spot, especially when you say you're catering to the needs of the market right now. So I wouldn't be surprised if I find some allocation to this particular issue. Of course, and number three, the last but not the least, it all depends on the price. You have
Okay.
to give clients some upside. So if it's a good price to earnings ratio compared to everything else out there, then they might see some buys. If it's a little too expensive, then some people might think twice.
Okay, but they're saying that 70% of the 1.5 billion proceeds will fund 25 to 100 stores in 2021. Is that a possibility? And the people are cutting capex on store expansion, and they're saying they will be expanding in 2021. Is that a realistic goal?
Um, well, number one depends how you see 2021 turning out. Is
Well,
this
yeah.
is this pandemic over? Are people consuming as much? They gave a range, so that's a good thing. So they know that probably the upper part of the range is if everything returns to normal. Maybe the lower part of the range is what if things continue as they are right now. So I would temper that, but
Okay.
they're in a sector that is interesting enough.
Okay, so interesting enough, it's not necessarily off the table yet. One question on the infra play. The government has said that this is what we need to be focusing on. We've actually had, Aboitiz Equity already saying that they're willing to do the airports. SMC now, the Skyway is going to start today again in the SLEX. So why, but we also did report the MCI earnings slumping, Eagle Cement as well, the whole SIM deal not going through with SMC. What's your outlook on infra? Will the build actually, does that still hold in this pandemic? Will that be seeing a V-shaped recovery?
I think the build is necessary for us to grow, simply because it was necessary before. It's necessary now. We will always need the infrastructure, even post COVID-19. But the question is, we need to put money in the pockets of people. So these construction workers, those people involved in these projects, that's the main point. You put them back to work, you get enough money for them, and they will have money to spend. And that's actually what pushes the economy up faster. You put disposable income in the money of your workers. So it's important. It's important that these
Okay.
guys get back online. Of course, practicing the regular, safe practices of social distancing. But it's important, very important.
Okay, so possibly maybe a bright spot here, but as you mentioned, it all depends on how long term your outlook is, especially as DMCI, after having reported its earnings, is in the red, slumping by 1.5%. Finally, before I let you go, Rob, I just want you to explain about this S&P 500 East West fund that you guys have. What's interesting to me is a lot of analysts have said that the S&P 500 has seen exuberance, right? It had seen all-time highs when the rest of the global markets were in peril. For example, even amidst the trade wars, now has been correcting. Why do you recommend? What's the insight here on why investors can maximize returns by investing in that type of fund?
Well, the interesting thing about this fund is that we launched it during these times of the global ECQ, the global quarantines or lockdowns. So, a couple of months back, we were thinking we had the approval to launch this fund, but I think you're right. Prices are quite high. But
Okay.
now that the prices have actually dropped, and for people who have long-term money, long-term dollars for as low as 500 US dollars, they can invest in the S&P 500 to diversify. At the same time, you're buying in at lower prices than what they were a couple of months back. So the assumption
Hmm.
there is that at this particular price is when the S&P 500 kicks back up, when global growth starts uh, ranking up again, you can ride that particular upside. That's why we created this particular fund.
Last question on that, Rob, before we end the broadcast. How does that compare to investing in the local index fund?
Actually, we also have a local index fund. It works together. At this point, if you invested in the index fund several months back, you're looking at price to earnings ratios at 16 to 18%. Quite expensive from that
Okay.
mindset. But now you're looking at an average for what, 11, 12? Although,
Yeah.
of course, things are quite volatile and people may be scared to come into the market. For those with long term money, you come in at 11 and 12, it's relatively cheaper compared to what it was a few months ago. So, when things normalize, and hopefully they do quicker than later or sooner than later, you can ride that increase.
Okay, so basically another option here for our investors, if they have risk of sentiment, they might be putting their money into more safe haven assets in the U.S., for example, and looking at an index fund for the S&P 500. Thank you so much, Rob Ramos rather from East West Bank for those insights today. And that was a first look into the business day. Today is May 15, 2020. Have a great weekend. See you guys again 10:30 a.m. on Monday. I'm Danny Laurel and we are One News.